Be Wealthy and Smart, episode 845.
Step into a world of wealth and financial freedom without budgets, boredom, or bosses on Be Wealthy and Smart. And now, here's your host, Linda P. Jones.
Welcome to Be Wealthy and Smart. I'm Linda P. Jones, America's Wealth Mentor, empowering women and men worldwide to financial freedom. On today's show, we're going to talk about the stock market correction that is underway. And this is something that I actually told my VIP members that we would experience starting on the 22nd, and that I felt that this would continue into mid-April. Doesn't mean every day is going to be down, but it does mean that we have probably around a 10+% correction coming. And that's long overdue. It's actually something that markets need to have regularly. It's part of investing. And getting that fear back into the market is a positive thing, because when things get out of control, a little bit speculative, and everybody's so sure the market's just going to continue to go up and there's FOMO galore, that's about the time you see a turn and you see a 10% correction, which I think we are just starting. So as I am doing this podcast, it actually is during market hours on Thursday. So I don't know exactly how the market is going to end today, but I'll give you an up-to-the-minute report on what's happened so far and what's causing this sell-off. There's basically a few things going on here. First of all, we have an issue with interest rates, and I did a podcast on interest rates last time, and that tipped us off that there was some more volatility coming in the stock market. It just so happens that interest rates, treasury yields, are reaching about an equivalent rate as the dividend yield on stocks. And when you get a treasury yield and a dividend yield on stocks about the same, it makes stocks less attractive. Now, I know that's not really something that makes a lot of logical sense right now, because who wants to settle for a 1.5% interest rate? That's not a lot of return to invest your money. It's just the way that the stock market does rationalize things. And when these certain points happen, where a riskless 1.5% yield is equivalent to a risky 1.5% yield on stocks, the money tends to flow toward the riskless asset or the treasury bills. What specifically happened in the interest rate market was a pretty sharp spike in the 10-year treasury as it went above 1.6%. The 5-year treasury yield went crazy and jumped 32%. This is the yield, the interest rate actually jumping 32% in one day, which is an enormous spike for bond yields. And that started to cause some of the imbalances in the market and for stocks to sell off. But there's more than just that going on. The real issue, I think, is a liquidity issue in the stock market. And that's because not only are treasury yields spiking, taking money out of stocks, and as I've been reporting, a lot of the, quote, smart money or institutional money has already left the stock market, but we're also seeing certain stocks or ETFs or hedge funds have liquidity issues. And that becomes very serious because it can snowball. So there is a certain technology ETF that has taken a lot of ownership in smaller technology companies, 10-15% ownership positions. And they got a lot of redemptions a few days ago. $500 million in redemptions, $500 million of redemptions came in. And they had to liquidate some of their stock positions in order to meet those liquidations from investors. Well, when they looked at their portfolio, they had small companies that they owned a good chunk of, and then there were larger companies that were very liquid. So they could easily sell their Amazon or their Apple stock, but the problem is the more you sell the more liquid companies, the more you're stuck with the less liquid companies. So that if redemptions continue to come in, you're going to be forced to sell less liquid companies, which means there could be major declines in those stock prices as you go to liquidate them. So that is a liquidity issue in a well-known ETF. There's also liquidity issues in hedge funds. As we see the meme stocks go back up, that is AMC Theaters, GameStop, and physical silver, we are seeing that the hedge funds that have shorted those companies or silver are starting to have heavy losses. GameStop woke up from its slumber at about $48 a share and went up to 97, and then overnight went up to 170 at one point, settling back to about 155. So GameStop caused the hedge funds to lose, I believe the number was around $80 million. So we have some serious losses in the hedge funds because of their illiquidity due to being short the stock, trying to pressure the price of a stock down, hoping they can buy it back later at a lower price, which at the present time is not going in their favor, which means they can have unlimited losses. As a stock that you're short goes up in value, that means your losses are theoretically unlimited because the stock can continue to go up and up and up, and the shorts are losing money as that happens. The other thing that's happening is the investment community is short the dollar, expecting the dollar to drop. But what's happening right now is the dollar is spiking. So it's effectively working against the entire market that took the wrong side of the position in the dollar. And that is working against many, many institutions who were betting that the dollar was going to continue to weaken. So it seems like the majority is getting caught with the dollar moving against them in the wrong direction, which will also cause liquidity issues. So if you remember, the last time the meme stocks started to run, these hedge funds are back in shorting GameStop again. They're doing the same trick again. This time, however, they have a new tactic. It's called Cloak Shorting. And what they're doing is they're shorting the ETFs that invest in GameStop stock, and then they're buying long the other stocks in the ETF so that you can't tell that they are short GameStop. And that's a way to get around the reporting requirements of how short they are because it doesn't appear in the shorting data against GameStop. So they're playing with trying to make it look like they're not short GameStop when in fact they are, again, short GameStop. So this is going to be very, very interesting to see how this plays out. This is extremely serious, and this is a liquidity issue. So this is what's going on in the market in many different areas. And meanwhile, the stocks that can be sold in order to raise liquidity, like Amazon, Apple, Netflix, and Facebook, are declining sharply as we're seeing some of this liquidity being drawn upon and these stocks being sold off for liquidity. Amazon today is down 2.5%, Apple's down 2.6%, Netflix is down 3%, Facebook's down 3%, and Tesla is down 6% and now below $700 a share. There was also information that could be driving down Tesla today that came out, which is that Elon Musk is being investigated by the SEC for his tweets that impact stock prices. So we'll see how that turns out. But what we're seeing is the larger companies, the larger tech stocks being drawn on as sources of liquidity. And this is causing more of the market to become illiquid, which could cause a huge liquidity squeeze. So we'll continue to watch and see what happens. I'm not expecting an enormous crash at this point. I think we are going to see this pullback at this time, another pullback later in the spring, and then the bigger pullback likely in the fall this year. So this is how I'm seeing it so far. We'll see how accurately I've called it, but that's my forecast, is about a 10% dip here, could be a little bit bigger than that, and then into mid-April, and then back to a bull market a little bit later into June, another pullback, and then back to the races with a bigger, more serious pullback in the fall. So we'll see how it all plays out, and I'll be reporting back to you. But these are very interesting times, and the name of the game is liquidity. That's all for today. Until next time, live the good life and be wealthy and smart.
Thank you for listening to Be Wealthy and Smart with Linda P. Jones. Share the wealth and tell your family and friends about the show. Check out our website, blog, and social media for more riches at www.bewealthyandsmart.com.